Splendid evening it is to you viewers. Welcome to Special Focus right here on Equity Access, your aerial perspective on stock market developments and on developments in the Zimbabwean economy. Ibn Mabunda signing in. Let's go. On Special Focus tonight, Edcon, which is Edgar Zimbabwe's parent company based in South Africa, is facing debt challenges. Simply put, they're failing to repay their creditors as well as their landlords in that regard. Now, in a statement yesterday, CEO Grant Patterson said that they are seeking an investment of $226 million in order for Edcon to remain operable over the next few years. Spectrum being, over the past few years, they have been grappling with high leveraging issues, with reports in December of the company facing liquidation. Well, they're still in the red and are looking to come back into the black. Hence the need for $226 million to stay operational. Well, Edcon owns 38% of Edgar Zimbabwe. As of January 16, 2019, a resolution was passed in an annual general meeting to increase that shareholding to 41% through an exchange of franchise rights for equity, in which that shareholding increases to 41%. Now onto the stock markets. For a sneak peek over the performance of the ZSE over the past month, the all-share index mounted 8%. Twinning that was the industrial index, which also came to 8%. The top 10 index scaled to 9%, while the mining's index slumped to 3.13 points, 6% loss. At the same time, the turnover for the month was $110 million, up 19% from $93 million over the past month. For a conversation on these and other issues, I'm joined in studio by our resident chief analyst, Respect Gwenzi. Respect, good evening and welcome to the show.
Thank you, my pleasure.
Beautiful. Let's get to business. Edcon, which is Edgar Zimbabwe's largest shareholder with 38% in that sense, is in this particular fix. And what is the significance of that in as far as Edgar's is concerned?
As the major shareholder, there is really a great risk of even failing to own up to their Zim investment. I think in the near future, if they fail to get the money that they want in terms of recapitalization, they might be forced to sell some of their assets, and Zim might be a weakness in that regard. So within their regional operations, Zim might really be one of those investments that they might be ready to shed off. Why? Because they have been failing to get their dividend. They have been failing to also remit some of their monies due to the rights of the local units to use some of their brands in terms of Jet and the Edgar's brand. So I think some of these low-hanging factors might cause Edcon to forgo Zim investment. So I think it's of significance that they're in quite this serious mess, and failure to rectify such might result in certain shakeups to the group structure in terms of who owns what, because they've been courting South African investors, some of the biggest funds, to inject a bit of capital, and some of them might ask for a reorganization of sort. So it might then get to impact Zimbabwe in terms of change of ownership, and who knows who ends up getting what in the local unit. But I think if we also look at the fact that in a recent extraordinary general meeting, there was passed a resolution to increase the shareholding, Edcon's shareholding in the local unit by this much of an equivalent of $1.5 million worth, to be settled through the issuance of 15 million Edgar's shares. So what this also shows is that the local unit is trying to de-link itself from the Edcon group. In case something happens in the near future, they will still continue to have the rights to use the Edcon brands, which are Jet and Edgar's brands. So I think it also speaks to the fact that even though they might be the largest shareholder, but in case that there's something that happens significantly to the parent, they will still retain the rights to the brands. So they might separate with the parent if the parent forgoes its shareholding in the local unit, but they won't necessarily lose the rights to use those brands. So I think some of the gestures just show that Edgar Zim is planning ahead in terms of potential shortcomings with regards to Edcon. So it's really a mess, but I believe that all these maneuvers may point to a solution. Edgar's being prepared for such.
Okay. Well, you brought an interesting subject there, the increase of the shareholding from 38 to 41%. But what is in it in as far as Edgar's is concerned, and how would that likely affect their operations getting into the future?
So the immediate impact is that it dilutes the present shareholder register as it looks like, because an additional 15 million shares effectively reduces other people's investment in that company as well. So that's the very immediate. But in terms of operations, if we are to look at Edgar's performance over the years, they've really been struggling at operating level. Okay. But then, as you can see, at PAT level, which is the black line, it shows that they've been able to close in gains. And these gains mainly reflect not the operating performance, but some of the income that they receive outside of normal retailing business. This is mainly finance income that's earned out of other services that they offer. So once they acquire the rights to these brands, it means they're no longer paying. The rights. They're no longer paying for the rights to Edgar's. So it reduces the operational costs that is due to them. So we might eventually see this loss position at operating level just being taken care of once that comes to play. But I think it's also important to note that revenue has been fluctuating over the years. A bit of a dip in 2016 and 17, and then a recovery in 2018 due to the macroeconomic volatility. So I think Edgar's has not been stable, especially due to the macroeconomic volatility. And so maybe once that this deal comes to fruition, we might see a reduction in costs going forward.
Okay, talking about macroeconomic conditions, their competitor, Truworths, in an annual general meeting that we did attend, mentioned that they were having problems restocking, particularly as the winter season is approaching. Where do they stand? Do you think that they're in a safe position in as far as restocking is concerned?
This is an industry-wide catastrophe that Zimbabwe is going through. I'm sure the Retailers Association came out a few weeks ago saying we won't be able to restock or to capacity if government does not intervene in terms of currency. They went on to be offered a bit of some money to settle creditors, outside creditors, and that has helped them a bit in terms of restocking. But then that's not sustainable. So unless the currency issue is resolved, we are likely to see a sustained challenge in restocking, especially those with foreign components of foreign exposure in terms of importing some of their raw materials or even full retail apparel. So these guys are exposed, and macroeconomic environment might really be a challenge to them.
Okay, moving on to the stock market. Interesting performance over the past month. We have seen the all-share index scaling 8%, as well as the industrials index, of course, as well in the same category would be the top 10 index going up 9%. What is the significance of that, or what do these figures reflect?
There's been buying appetite into 2019. Investors still feel that the stock market is a better investment option against many of the various other options that are there. Okay. So there's been accumulation, further consolidation of shares. That means share prices have been rising irrespective of maybe stagnant performances. Most of the companies haven't released results as yet, but most of the stocks have really gone up. 30 over 30 counters up in terms of year to date, which is in January alone, and just about 12 counters coming off. And we are coming from a period where we saw a significant gain in the stock market over the 2018 period. So between January and December, the stock market went up about 46%, even coming from another serious or significant gain in 2017. But then that momentum coming from this point here is still being carried forward. So I think investors are really finding stocks to be a better option. And in January, we really saw a huge buying momentum. But that's also closely depicted in terms of the values. Because when buying appetite or when demand is up, we also see prices rising. But this has got a clear linkage to the the prevailing macroeconomic environment where inflation has been going up. We saw this, the latest December figure at 32%, at 42%. It's really a significant gain from the prior months or the prior month and the other previous months as well. So investors really need to get into safe haven, and they're finding stocks to be an option, despite that we are clearly in an overvalued market. So both the industrial index and the mining are up, but also other indices as well. The two other indices are up by an equally fair margin. But when you then zoom in
hold on a second. While the all share, the top 10, as well as the industrials have been on an upward trend, we seem to see that the mining's index slumped 6% to 213.13 points. Why the discrepancy in that sense?
If you look at what fraction of the market is represented by the mining index, it's quite insignificant, and there's not been as much activity in terms of the four counters that are in that sector. And in terms of performance as well, most of them are shaky. Recently, Wange is put under reconstruction.
Yes.
What do you call it? Rio Zim. We also saw a slump in performances in terms of miners cutting down their production in the last quarter of the year. And there are also still issues to do with recapitalization and Bindura insolvency, and it has been failing to push momentum in terms of nickel prices. But lately the prices have been off a bit. So I think generally when you look at the mining companies in terms of real value or fundamental drivers, they have not been as much favorable. And also looking at the production side, given what's happening on the macro side, failure to be given enough dues, all that I think dampens the prospects of the sector, and it might have driven investors to feel that they can invest elsewhere other than the stocks, other than the mining stocks. But generally, the mining index is disconnected to the broader market. Hence, the recent inclusion of the mining index within a broader index, which is called the ZSE All Share Index, because of that kind of discrepancy. Because mining, the real reason why they had to put mining separately in the first place was that Zim is a predominantly agric and mining economy. So they thought over the years we're going to have more mining counters listing, and its impact on the overall bourse might be significant. But that has not been the case. So I believe the movement is just a disconnect from the actual economic trend. I think if we then look at the all share index, which consolidates both, we can see quite a general view, and that view is telling us that investors are moving into stocks.
Okay. For the month of January, our turnover was $110 million, up 19% from $93 million in the month of December. What was the effect of the shutdown? Because I think we had a good 1 week in which the stock market was shut down. What is the impact of that in terms of that is, in as far as that is concerned?
It might be interesting for you if you look closely at the data that the impact of the shutdown was actually positive to the market.
Okay.
In what way? Because prior to the shutdown, the market was down 7% on a year-to-date basis. Post the shutdown, the market accrued more than 10%.
Interesting.
As the market rose, so was the value traded.
Okay.
Investors felt we need to get more into, we need to cover ourselves more. So they pushed more of their monies in stocks. So from that end, we can see that there was a positive impact. Okay. But when you talk about the days over which the stock market was not really trading consistently over the shutdown period, if you look at the actual number of days, January we traded 19 exact days, which is the same number as December. So there wasn't any numbers effect to say if we could have traded in 30 days or in 25 days, we could have achieved such a higher turnover or something like that. So in terms of loss of trades, it didn't affect the trade, because similar trading days to December, but an increase in terms of turnover. And when you look also in terms of the average daily turnover, it has now gone up to about 4.5 million, okay, up from 1.2 million just a few years ago. Okay. And last year we were sitting at almost 2.5, and that's a huge growth in terms of the average value, the average daily traded values. Okay. And that just shows you there is enormous appetite in terms of investors wanting to get into stocks, irregardless that foreigners are trying very hard to exit the local market.
Okay. And lastly, before we go, we are looking forward to a monetary policy statement by the RBZ. What do you think we can look forward to?
Yeah, it's not as easy to predict in terms of what might come, because we are pretty much in an unpredictable terrain. Policies can just be announced from nowhere, and they might seem to be disconnected from the reality on the ground. You might recall the 1 October monetary policy. Some policy measures were introduced out of the blues, caught everyone unaware. So I think we can only speculate, but I think it's on everyone's mind that the currency regime has to be sorted out. Issues to do with clarity on the currency issue has to be put forward. Either we liberalize, either we follow A or B, re-dollarize and whatnot. But the government has made it clear that our indications are that we are going towards a Zim dollar. And the minister has said it might take us at least, at most 12 months. But okay, there's serious speculation that we might not get that far, because the house is burning and there is need for a prompt response. And government might cut short. They might take the shortcut to solving some of these problems. They have been on record to say we will only introduce a currency once fundamentals improve. And these fundamentals include a positive trade balance, as well as fiscal stabilization, which will ensure stability of our own currency. But these factors they're far from being achieved. In terms of the fiscal side, October and November have been good, and the minister might be tempted to want to believe that Zimbabwe is already achieved rebalancing its books. But 2019 is a whole different. It's a different game altogether. Why? Because inflation is raging, and we might see government overlapping its expenditure. The current tiff with civil servants who want a salary increase already. Government has banded a few weeks back. They were given something unbudgeted for, and there's still pressure for them to respond. And before you know it, we start going back again to borrowing from the public from the private sector, increasing our expenditure, inflation going up, and that means further currency instability. So I also project that the governor might make a move on the currency issue. Okay. We might get a surprise, early surprise to the year in terms of local currency. Okay. But I don't believe it is the best thing for Zim to do right now, unless if it's done in a way that it addresses certain macroeconomic challenges. You don't want to introduce a currency today and it crashes tomorrow because there's no confidence. there is not yet that confidence. We're just coming from a very worrying year. January has begun on a very sad note, and confidence is at its lowest, and there's no currency which doesn't thrive without confidence. So it's important that we ensure that, and it's also important that we become sure that we have really achieved fiscal stabilization, which I don't believe that we have. In terms of the external trade position, which is key in terms of generating us forex, that position is not likely to be closed anytime soon, because recent statistics show that we are sitting at a negative 2.5 billion annual deficit in 2018, which is actually wider than the 2017 gap. So we are not yet there in terms of our external trade. So I don't think we can be able to achieve forex reserves which are necessary to also stabilize the currency. But they show a need to address the crisis. Might be worth borrowing from certain economies like Nigeria. I mean, it's trying to stabilize the market, but not a hard landing. A hard landing introducing a dollar right away would definitely lead to a crash, something like that.
Oh, thank you for the perspectives. Respect. That's it for tonight. Thank you, viewers, for watching. Don't forget to like, subscribe, follow us on Twitter, Facebook, and to visit our website www.equityaccess.net. From Respect and I, thank you for watching and good evening.